Hey everyone, it's Julie here with Tip Ranks. Today we're taking a look at 3 strong buy consumer defensive stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at stocks in the consumer defensive sector. These are companies that sell goods and services that are considered essential. Think food, beverage, household products. And these are products that people need regardless of economic conditions, so they can offer a bit more stability during uncertain times. We found today's stocks using the TipRank Stock Screener. Found underneath the screener menu, today we looked for stocks with an outperform rating on the TipRank Smart Score, a double-digit upside potential, strong buy consensus, and of course the consumer defensive sector, which gave us our list of companies down below. So today we're going to take a look at these companies, what it is that they do, and what those Wall Street analysts are predicting for the stock's future. You can check out the stock screener for yourself right on the TipRanks website or on the TipRanks mobile app, which you can download using the links in the description down below. Now let's get right into our 3 strong buy consumer defensive stocks. First up, we're taking a look at SunOpta. They trade under the ticker STKL, currently priced at $5.73. Overall, in the past year, they're up just 1.4%, having dipped over 26% in the last 3 months, but climbing back since. SunOpta manufactures and sells plant-based and fruit-based food and beverages, focusing on organic, non-GMO, and sustainable products. They produce items like plant-based milks, including almond, soy, and coconut, creamers, broths, teas, protein shakes, and fruit snacks for both their own brands like Dream and Westlife and private label brands for retailers and food service providers. On May 7th, they shared their first quarter earnings report, where they came out with both an earnings and revenue beat, plus an increase to their 2025 revenue guidance. They reported Q1 earnings per share of 4 cents, beating estimates by 3 cents per share, and revenue climbed 9% year over year, coming in at $201.6 million. Looking forward, they bumped up their revenue guidance to $788 to $805 million. SunOpta's CEO said that their first quarter results exceeded expectations across the board, and that their efforts to unlock latent capacity are ahead of schedule, and that their margin improvement initiatives are expected to deliver quarterly sequential margin increases throughout 2025. They're also seeing growth in their sales pipeline, reflecting incremental opportunities from both existing and potential new customers. Their stock does just have 4 current analyst ratings, but comes in as a unanimous strong buy. And the average price target of $9 implies an upside potential of 57%. Looking at those price targets down below, they range from 22% upside all the way to 75%. For our second stock, we're switching gears from that smaller company to one that is much more established in this sector. That is Keurig Dr Pepper. They trade under the ticker KDP, currently priced at $32.59. They are down a couple percent in the past year, having fallen into the new year, but are slightly green in the last few months. Keurig Dr Pepper is a well-known leading beverage manufacturer in North America with over 125 brands. They offer products like carbonated soft drinks, including Dr Pepper, 7UP, Canada Dry, coffee, teas, juices, water, energy drinks, and non-alcoholic mixers. They're also known for their Keurig single-serve coffee brewing systems and their K-Cup pods. Their latest quarterly report came out near the end of April. They also had an earnings and revenue beat and reaffirmed their full-year guidance. Q1 earnings per share of 42 cents came in 4 cents ahead of analyst expectations, while revenue climbed nearly 5% year over year to $3.64 billion, beating estimates by $80 million. They saw the successful integration of Ghost Energy and saw market share gains across brands like Dr Pepper and Canada Dry. Following that quarterly report, we did have an analyst from HSBC upgrade the rating to a buy. They said the company managed to build some cushion for holding on to its full-year guidance and sees the company as being in the right place with the right brands. Keurig Dr Pepper led the industry on coffee pricing, and as others catch up, the second half looks promising. Their stock has 14 current analyst ratings, coming in as a strong buy with 11 buys and 3 holds. And the average price target of $39 implies an upside potential of over 20%. Looking at those price targets down below, they range from an upside of 4% up to over 28%. If you've made it all the way to our third stock today, then this is a reminder to make sure you've hit that thumbs up button. Last but not least, we're taking a look at Smithfield Foods. They trade under the ticker SFD, currently priced at $23.45. When we look back at the chart, the company just actually IPO'd in January of this year, and so far has gained about 13%. Smithfield Foods manufactures and markets packaged meats and fresh pork, both in the United States and internationally. They're a wholly owned subsidiary of WH Group, which is a Hong Kong-based company. They produce a wide range of fresh pork, bacon, sausage, ham, and packaged meat products under brands like Smithfield, Eckrich, Nathan's Famous, and Armour. They operate farms, processing plants, and distribution facilities primarily in the US, but also in countries like Poland, Romania, and Mexico. They emphasize sustainability, animal welfare, and food safety. As a newly publicly traded company, they do just have 2 quarterly reports under their belt. Their latest report came out near the end of April. They had an earnings and revenue beat, plus saw record-breaking first quarter operating profit. Earnings per share of 58 cents came in 10 cents ahead of analysts' expectations, while revenue climbed nearly 10% to $3.78 billion. Their first quarter operating profit came in at $326 million, which marked an 86% increase to the prior year. Following that first quarter report, we did hear from an analyst at Morgan Stanley. They noted that the reaffirmation of Smithfield's fiscal year guidance, despite potential challenges such as China tariffs, indicates a conservative yet positive outlook. The company's low valuation, combined with a 5% dividend yield, suggest further upside potential for investors. Smithfield Foods has attracted 9 current analyst ratings and comes in as a strong buy with 8 buys and 1 hold. The average price target comes in at $27.75, implying an upside potential of over 18%. Looking at those price targets down below, they range from a slight downside of nearly 2% with that hold rating to a high-end upside of over 36%. So that is a quick look at 3 strong buy stocks that fall into the consumer defensive sector. Let me know your thoughts on these companies in the comments down below. I always appreciate hearing from you guys. Of course, please keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you always do your own research and due diligence before making any investment decision. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.